Most people think that life insurance only pays out once you die, like some sort of static number that never changes. But what if I told you that the death benefit on a properly structured infinite banking policy actually increases every single year that you're alive, even if you stop putting money into it? That's right, your protection actually grows while you're still alive. And that's one of the main reasons that the wealthiest families love these policies and use them as a staple in their financial lives. My name is Devin Burr. In this video today, I'm going to show you exactly how and why the death benefit rises over time, and how you can actually use this knowledge to not only use your life insurance policy while you're alive, but also to give you a legacy for your family that continues to compound long after you're gone. So if you are new to my channel, as mentioned, my name's Devin Burr, aka Mr. Burr. I went from being dead broke, we're talking about $300 to my name, had to file Chapter 7 bankruptcy, I was almost homeless with my 9-year-old daughter Haley, to being a multimillionaire and my very own banker. I don't have to rely on banks anymore. I am the bank. And I did this by using this exact concept. I not only use this to have cash for different things in my life. If I want to buy a vehicle, I finance that through my bank. If I want to go do investments, real estate, or be a private lender, or dividend paying stocks, which I made a video about, I'll link it up here, how I use this concept to buy dividend paying stocks. I use this for everything. And not only that, it gives me a death benefit that rises the longer I live. So the longer I live, the more my family is taken care of when the inevitable happens, which is death. I'm guaranteed to die. You are too. We just don't know when it's going to happen. But hopefully it happens way in the future. And the longer I live, the bigger the payout for my family. So everything I'm going to show you guys today is it's not theory. This is what I actually do for me, my family, and my clients. So let's talk about how the death benefit works. In a properly structured infinite banking policy, you've got two components, two things that are essential. First thing is you have your base premium. This is like your regular off-the-shelf whole life insurance. This is what Dave Ramsey says is the worst place you can put money. This is basically a death benefit. Base premium pays for your death benefit, okay? Doesn't get you much cash value early on. Takes a while to start creating cash value. Then the second component is paid up additions, or PUAs. PUAs, those get you a whole bunch of cash value. This is what Dave Ramsey does not talk about. He doesn't understand this, obviously, or he'd be doing a lot more of this. But paid up additions gets you a whole bunch of cash value, a whole bunch of liquidity that you can go and use for whatever you want without interrupting the guaranteed compound growth that a life insurance contract gives you. Paid up additions gives you a bunch of liquidity, a bunch of cash value, but also a little bit of death benefit. So every time you contribute paid up additions, you're getting a compounding cash value and also a compounding death benefit. It just keeps rising the more you get those PUAs in there. Next thing I'm going to cover here is exactly how the policy is built to do what I just mentioned, how the paid up additions continue to rise the death benefit. I'm going to show you actually one of my policies a little later in the video so you can see how the death benefit keeps going up. But here's essentially what we do to make this work. The base premium, we're lowering this down. So we're making this really as low as we possibly can without the policy becoming a modified endowment contract. That just makes it taxable. You don't want that. You want this all to grow 100% tax-free, which if it's designed properly, it'll never be taxed. You'll just keep growing and growing and growing without ever having to pay Uncle Sam. So what we do is we lower down this base premium. The base is where all the commissions are. So we're actually lowering down our commissions and then having you overfund, so to speak, the base premium with paid up additions, PUAs. So we're lowering the base, raising the paid up additions. And we're finding the sweet spot where that works without it becoming a modified endowment contract. Now, this is the crazy part. Most agents, they're not going to tell you this. They're not going to design it this way because think about what I just said. We're lowering the base. The base is where all the commissions are. Paid up additions give very, very little commission. We're talking about like 0.2%. It's very low. Base can be up to like 85, 90% of what you put in. So this is where most agents want to steer you. They want you to put money into base so they get a big old commission check. We're lowering the base. So we're lowering the initial death benefit and we're raising the paid up additions. So that way you're getting a whole bunch of cash value, lower death benefit up front, but a whole bunch of liquidity that you can use right now. And then what we do, this is super important, is we have your dividend option. So you've got your dividends. Dividends are not guaranteed, but the companies we use have paid a dividend every single year for like 140 years. So they're pretty much a sure thing, but they're just not guaranteed. Once you get a dividend from the insurance company, there's options that you can have written in your contract. You can change these options. You can have the dividend paid to you, so you just get it as income, so to speak. You can do a lot of different things. What we do, how we design these for infinite banking, is we have the dividend option purchase more paid up additions. So think about that. You've got a vehicle that's lower commissions, lower death benefit up front, higher paid up additions, higher cash value up front, a little more death benefit when you have paid up additions. It doesn't get you a bunch, but it does get you death benefit. And then when you have a dividend, which these companies are always paying dividends year after year after year for over a century, when that dividend hits, we have it purchase more PUAs. So since this dividend is purchasing more PUAs, you're getting an ever increasing cash value. Because remember, the PUAs get you instant liquidity. They also get you a little death benefit. So you have an ever increasing cash value that you can use for whatever you want to go become your own bank, and an ever increasing death benefit, which is a beautiful thing. So you're getting the best of both worlds. You're hoping you live a real long time. The longer you live, the bigger the death benefit payout. The longer you live, the more cash value you have because it's a guaranteed compound vehicle. You're always going to have more than you had the year before. It's guaranteed. It's contractually guaranteed to be that way with no taxes. Then, again, the longer you live, death benefit keeps going up. When you pass away, your family is left with a big ol' death benefit tax-free. Beautiful part two, everything you're putting into this contract is protected from lawsuits and judgments in most states. So not only are you building this huge legacy for your family, not only are you able to use this cash value for whatever you want without interrupting the guaranteed compound growth, you're also protecting your money. It's the safest place for money to sit. If it's sitting in your bank account, it can be taken on a judgment or a lawsuit. If it's sitting in your policy, it can't really be touched. It's got creditor protection in most states. Some states, 100% creditor protection, which is incredible. So you're getting all these things along with storing your money in a place that has a track record of being profitable every single year for over a century. That's what dividends are. When the company is profitable, they share those profits in the form of a dividend. The reason being, it's a mutually owned company. That means when you're a policy holder, you're a mutual owner of that insurance company. So when they're profitable, they give you a dividend because you're a part owner. And the more you flow to it, the bigger the dividend gets. The bigger the dividend gets, the more paid up additions it buys. By default, you don't have to do this. We set it up this way for you. It buys more paid up additions, which instantly gives you more cash value and instantly gives your family a rising death benefit. So that when you pass away, it is guaranteed to happen, your family gets a big old tax-free death benefit. So I'm going to jump into one of my policies so you guys can see it and see how this dividend is actually purchasing more paid up additions, which gets that ever increasing cash value and also gets the ever increasing death benefit. Let's check it out. All right, guys, so check this out. This is a policy. You can see this is on my wife, Danielle. We got this for her when she was 27 years old. She was in extremely good health and she doesn't do tobacco. So this is a policy I have on her life. The first year we put in $100,000. So the base premium that I was telling you guys about is 5,300 bucks. That's the base. All of this extra amount are paid up additions. So we're just maxing out the paid up additions as much as we can to get as much cash value as possible. So this is all on the guaranteed side. So this is assuming that the insurance company never paid out a dividend, which again, this company's paid out a dividend every single year for like 140 years. But assuming they never paid one, this is what the cash value would be. So look, put in 100 grand, she's got access to 90. That's insane. So we got access to 90 grand. We can go take that, make more money with it, however we want to do, without interrupting the guaranteed growth of the 100,000 bucks. Now check this out. So the dividend is going to be 1,300 bucks that year. Now, what they do is they take historical data. So they look at the prior year and base the dividend going forward off what they did the prior year. So when this policy was written, let's see, she was 28, so this was 4 years ago. So this was a pretty low dividend year. And the dividends have actually outperformed this policy. This is the policy when it was written. I should have pulled up a in-force illustration, but this dividend, this 1,300 bucks, this is going to go purchase more paid up additions. So as you can see, the cash value at the end of the year, it's a little bit higher. 90,200 at the beginning, that's just without any dividend. And the dividend gets you a little more cash value. But look at the death benefit. It goes from 5.231 to 5.342. So it went up because the dividend purchased more paid up additions. It got us more cash value, but it also got us more death benefit. And this happens every year. So look, the dividend this second year, 1560. It's going to get us even more cash value. We put in 20, the cash value increases by almost 20. That means we can almost use exactly what we put in that year. It's efficient already basically in year 2. The dividend buys more paid up additions, so we have an even higher rise in the death benefits, all the way up to 5.4 mil. So that is how a death benefit rises inside of an infinite banking policy the longer you have it. The longer you live, the bigger the death benefit gets because that dividend is constantly purchasing more paid up additions. You got more cash value and more death benefit. What I do with my family, and this is something I would highly suggest all of you do, is have a trust set up. A trust where when you pass away, the death benefit goes to the trust. The trust is the beneficiary. So instead of millions of dollars going to your kids or to your wife or whoever is the beneficiary, instead of that, it goes to a trust. Now, the trust has a succession plan, meaning it's basically a roadmap for how you would spend the money once you're gone. So the succession plan that I have inside my trust is death benefit goes there, tax-free. There's no taxes, no income taxes whatsoever. It goes there. Now the succession plan states that that tax-free money has to purchase more infinite banking policies. Think about that. It's tax-free money purchasing more policies that grow tax-free, that have high cash value right away. So my family can use that cash value following the succession plan of how to practice the concept of infinite banking. And those new policies are going to be on other family members. So, recap, I pass away. Death benefit goes to my trust, tax-free. That trust has a succession plan that states that that tax-free money has to purchase more life insurance policies on other people in the family, my kids, my grandkids, if it's that far down the road. Now, those family members, again, have money that's growing tax-free that never got taxed, and they can use it to be their own bank. It's going to have a ton of money in it because the death benefit keeps rising. So they won't have to borrow money for anything, not for houses, not for cars, not for investments, nothing. They borrow from the family bank. Then they're going to pass away at some point. So when they pass away on those new policies, guess who's the beneficiary? The family trust. So when they pass away, all that death benefit goes to the family trust, tax-free. The succession plan states has to purchase more policies that are just like this on family members. And my family just gets wealthier and wealthier and wealthier with never having to worry about financial things at all. They never have to worry about where they're going to finance this or finance that. How are they going to get the money for this, the money for that? This is what the Rockefeller family has done for generations. I'm sure you guys have all heard about John D. Rockefeller. He was extremely wealthy. At one point, at the height of his net worth, in today's dollars, he was worth $600 billion. I think Elon Musk is worth about $300 billion. So he had twice as much net worth in today's dollars as Elon Musk. How did he sustain that wealth? How is the Rockefeller family still one of the elite families? And it's because of life insurance and the trust structure they have set up. So guys, I would love to hear what you think about this in the comments. Let me know what questions you guys have, what you think about what I've said, if you agree with it or disagree. Also though, if you're ready to do something like this, set your family up for generational wealth. Have a death benefit that rises the longer you live. But not only that, be able to access the funds, the cash value right away, and have that cash value increase guaranteed throughout your life. If you are ready to do that, that's all my team does. We do not set up Dave Ramsey policies. We don't set up term insurance. Term insurance is the most expensive. It only pays out 1% of the time. That means that the other 99%, the insurance company was collecting all those payments and you got nothing out of it. We only set up policies like this that are built for infinite banking. And then what we do is we set it up. You don't pay us a penny. We actually get it to the finish line. You fund it with the insurance company. They pay us for bringing the business, but then we work with you to help you use the policy. That's the main thing. If you have the best policy written, it's really just a very, very, very good savings account if you don't know how to use it. We show you how to use it. So our team will work with you to make sure you implement that policy and you can get the most out of it. If you are ready to do that, check out the link in the description of this video. Register for my free training video. I go over exactly how these policies work and how you can use them in your life to buy cars, to pay off debt, and just watch that video. You'll learn a ton. At the end, you'll be able to schedule a call. So that way we can help you. There's never any selling. We don't sell policies. We teach a concept. And if you understand the concept, you're gonna want the policy. So I hope you guys enjoyed this video. If you got value from it, share it with somebody else. Like the video too. The algorithm loves it when you like videos. So please, I would appreciate that. If you got value, smash that like button. If you're not subscribed to my channel, make sure to do that now. Hit the bell so you get notified when I put out these videos. And if you enjoyed this video, I'm telling you what, you should check this one out next. You're gonna love that one. Until next time, love all you guys. Peace.